You know, I've been leading JPMorgan Chase for more than 18 years. During that time, I've guided this institution through the most severe financial crisis since the Great Depression. I've been in closed rooms with presidents, central bank leaders, and finance ministers at moments when the global economy was literally just hours from collapse. And after all those years and all those crises, I've never been more worried about one simple mistake that nearly every American is making with their money today. They're holding far too much cash. I realize how strange that may sound coming from a banker. After all, banks are the ones that take deposits, promote savings accounts, and market CDs and money market funds. But let me share something that may surprise you. In 2026, holding cash could turn out to be the single biggest financial mistake you make. Not cryptocurrency speculation, not meme stocks, not even excessive leverage in real estate, cash. And I'm not talking about keeping a sensible emergency reserve. I'm talking about the roughly $6.6 trillion that Americans currently hold in cash and cash equivalents. That money is earning around 4% or 5% in money market accounts, while inflation is quietly and consistently eroding its purchasing power. It feels safe, but in reality, it's losing value day by day, much like ice melting under the sun. I understand why people are doing this. Markets have been volatile. There's uncertainty around interest rates, the broader economy, and global geopolitics. When people feel anxious, they move into cash. It feels secure. It feels liquid. It feels like avoiding risk altogether. But that sense of safety is an illusion, and in 2026, that illusion could come at the cost of your long-term financial future. Let me explain why. First, it's important to understand what's really happening with interest rates. Yes, the Federal Reserve has raised rates aggressively over the past 2 years. And yes, today you can earn about 5% in a money market account. But that environment won't last. I've spent enough time in banking to know that periods of high interest rates are temporary. They always decline. When they do, that 5% return becomes 3%, then 2%, then 1%, turning cash into a guaranteed losing position. But even if rates somehow stayed at 5%, which they won't, you'd still be losing money. Real inflation, not the official statistics, but the actual increase in everyday living costs, is running closer to 7% or 8%. Housing, healthcare, education, food, and energy, the things people actually spend money on, are rising faster than the return on cash. That means a 5% yield is really a negative 2% or 3% return in real terms. Your wealth is shrinking, slowly but steadily. I learned this lesson firsthand in the 1970s, when I was early in my career at Goldman Sachs. Inflation was out of control, reaching double digits, and people who held cash suffered deeply. Not gradually, but sharply. I watched intelligent, well-informed individuals lose 30% or 40% of their purchasing power in just a few years because they believed cash was safe. They discovered too late that in an inflationary environment, cash can be the riskiest asset of all. And we are moving into another inflationary era. Not a brief spike like we saw in 2021 and 2022, but a longer-term structural shift. The reasons are clear. The dollar has been weaponized through sanctions. Global supply chains have been disrupted. Trillions have been spent on fiscal stimulus. Energy policy has become driven by politics rather than economics. And most importantly, central banks have shown that they will always choose to inflate away debt instead of allowing deflationary collapses. Every major economy is burdened by massive debt. U.S. national debt is above $34 trillion and rising. Corporate debt is at historic highs. Consumer debt is also at record levels. When debt reaches this scale, there's essentially one path forward: inflation. Debt is reduced by steadily lowering the real value of money over time. The Federal Reserve understands this reality. They may publicly emphasize a 2% inflation target, but when forced to choose between a deflationary recession that could bankrupt governments and sustained inflation that eases debt burdens, they will choose inflation every time. There is no alternative left. In the current environment, holding cash is not a way to protect capital. Cash is slowly eroding your wealth. Every month you keep large amounts of cash beyond what you need for emergencies, you are effectively choosing to lose purchasing power. So let me explain what you should do instead. At JPMorgan, we manage more than $4 trillion in client assets. Our investment outlook for 2026 looks very different from what many people expect from a traditionally conservative institution. Yes, we are advising clients to be defensive, but not by holding cash. Instead, we recommend what I call productive assets. Assets that generate cash flow, benefit from inflation, and retain or grow their value when currencies lose purchasing power. The first category is dividend-paying equities, but not just any dividend stocks. We focus on companies with pricing power, businesses that can increase prices faster than their costs rise. These are usually market leaders with strong brands, essential products, or natural monopolies. Think of utility companies that pass higher energy costs on to customers. Think of consumer staple companies with loyal customers that allow regular price increases. Think of technology firms with critical software that businesses cannot operate without. At JPMorgan, we have identified roughly 150 companies in our coverage universe that meet these standards. These companies have raised dividends consistently for at least 10 years, maintained profit margins above 15%, and operate in industries with high barriers to entry. They do more than preserve purchasing power, they expand it. When inflation rises, they increase prices, profits grow, and those gains are shared with shareholders through higher dividends. Compare this with a money market account. When inflation rises, your real buying power declines. With these companies, rising costs are typically offset by even faster revenue growth, benefiting you as an investor. The second category is real estate, though not in the additional sense. I am not referring to buying rental properties or managing tenants. I am talking about real estate investment trusts, or REITs, vehicles that own income-producing commercial properties such as office buildings, shopping centers, warehouses, data centers, cell towers, and healthcare facilities. REITs matter because real estate has historically been one of the most effective inflation hedges. As the cost of living increases, rents rise. When construction costs go up, existing properties become more valuable. By law, REITs must distribute at least 90% of their taxable income to shareholders. That means you receive income that adjusts with inflation, along with potential capital appreciation as property values increase. At JPMorgan, our real estate investment banking team tracks every major REIT in the country. What we see today resembles conditions from the early 1970s, before inflation accelerated sharply. Property fundamentals remain strong, but REIT valuations are still reasonable because many investors fear rising interest rates. What they overlook is this: higher rates may initially pressure REIT prices, but when those rates are driven by inflation, as they often are, rents tend to rise faster than borrowing costs, allowing REITs to benefit over time. I once had dinner with Sam Zell, one of the most successful real estate investors in history, shortly before his passing. He shared advice I will never forget. He said, "When people fear inflation, be a borrower and own real assets. When people fear deflation, be a lender and hold cash." Today, investors are focused on the wrong concern. They worry about interest rates when they should be concerned about currency debasement. They focus on short-term market swings instead of long-term erosion of purchasing power. The third category involves international exposure, particularly emerging markets. I understand the concerns. Emerging markets can be volatile, politically unstable, and subject to currency swings. That is all true. But what is also true is that many of these countries have younger populations, faster economic growth, and currencies supported by real commodities rather than excessive debt. As the dollar weakens, which is likely given ongoing fiscal pressures, these markets and currencies stand to benefit. At JPMorgan, we have been gradually increasing exposure to countries such as India, Indonesia, Brazil, and select regions in Africa through our private banking clients. Not because we ignore risk, but because we understand how monetary systems work. When money is created without limits, it eventually loses value relative to tangible goods. These countries produce essential resources, food, energy, and raw materials, the foundations of economic survival and growth. The fourth category is precious metals. Before dismissing this idea, let me clarify the purpose. Gold and silver are not growth investments. They are insurance. They serve as protection against currency debasement and political instability. For thousands of years, whenever governments weaken their currencies, people turn to precious metals. That behavior has not changed simply because technology has advanced. This does not mean buying physical coins and storing them at home. Exposure can come through precious metals ETFs, mining companies, or what the financial industry calls monetary metals exposure, typically around 5% to 10% of a portfolio. The goal is not rapid wealth creation, but protection. When confidence in paper currencies declines, investors move toward assets that cannot be printed. At JPMorgan, we operate one of the world's largest physical precious metals vaults. We store gold and silver for central banks, sovereign wealth funds, and family offices. The level of institutional demand we are seeing today is unlike anything I have experienced in my 4-decade career. This demand is not coming from speculators, but from long-term institutions that understand monetary history. Now let me explain how to put this strategy into practice, because knowing the approach and executing it are very different things. First, you must be systematic. Avoid trying to time the market or waiting for ideal conditions. Set up automatic investments that gradually move funds from cash into productive assets each month. Dollar cost averaging works especially well during uncertain periods, allowing you to buy more when prices are lower and less when prices are higher. Second, focus on cash flow rather than just price appreciation. The objective is not dramatic gains, but steadily increasing income streams that grow faster than inflation. Each quarter, your dividends, rental income, and distributions should be higher than before. That is how lasting wealth is built. That's how you safeguard your standard of living, no matter what happens in the economy. Third, global diversification is essential. Don't concentrate all your investments in the U.S. While we account for roughly 25% of global GDP, the U.S. stock market represents about 60% of global market capitalization, a level T. That isn't sustainable long-term. Consider owning companies in Europe, Asia, and Latin America. Hold currencies beyond the dollar and assets across multiple jurisdictions. Fourth, understand tax efficiency. Whenever possible, keep REITs and dividend-paying stocks in tax-advantaged accounts. Use tax loss harvesting to offset gains, and explore municipal bonds if you live in high-tax states. The goal is to retain as much of your returns as possible, instead of giving them away to taxes. But the most important lesson I've learned from running JPMorgan through multiple crises is this: you have to be willing to act early. You must accept looking short-term foolish to be long-term correct. In 2007, while everyone was heavily invested in mortgage-backed securities, confident the housing boom would continue indefinitely, we reduced our exposure. It made us appear conservative, even as our stock lagged and analysts questioned our strategy. But we understood that unsustainable trends eventually break. When the 2008 crisis hit, we were one of the few major banks that didn't require a government bailout. A similar situation is unfolding now with cash. People assume cash is safe, believe the Fed is fully in control, and think this time is different. But monetary history is clear. Creating money faster than goods and services causes inflation. Excessive debt leads to currency debasement. Political dysfunction and fiscal irresponsibility erode confidence in paper money. The signals are visible if you know where to look. Central banks are buying gold at record rates. Sovereign wealth funds are diversifying out of dollars. Institutional investors and multi-generational family offices are quietly moving into hard assets. They are not holding cash. They are preparing for what's ahead. Here's what concerns me. The average American family is unaware of these trends. They hold cash because advisors recommended it, because they fear stock market volatility, or because they misunderstood advice to keep 6 months of expenses liquid, interpreting it as storing it in a savings account earning 5%. Liquidity doesn't have to mean cash. Short-term treasury bills, high-grade corporate bonds, or dividend-paying stocks that can be sold in emergencies all count. Your emergency fund shouldn't guarantee a monthly loss in purchasing power. From my years in banking, I've learned that the greatest risks are not the ones making headlines. The biggest dangers are slow, quiet, invisible. Holding excessive cash is like carbon monoxide poisoning. You can't see it and you don't feel it, but it steadily erodes your financial future. By the time people realize their cash has lost 30 to 40% of its purchasing power, it's often too late. They are too old for high-risk investments, too close to retirement to pursue growth assets, effectively locking themselves into a lower standard of living for life. Don't let that happen to you. Don't let the illusion of safety become lifelong poverty. The window to reposition your portfolio is closing. Not next year, not next decade, but now. Every month you hold excess cash is a month lost. This isn't about get-rich-quick schemes, speculation, or taking reckless risks. It's about preserving the wealth you've built and ensuring that your lifetime savings maintain their value. This is about financial survival in a world where the rules have fundamentally changed. The choice is yours. Continue following conventional wisdom and risk eroding your purchasing power, or recognize that extraordinary times require extraordinary measures. I know what I would do, what I am doing, and what history teaches about those who fail to adapt to changing monetary conditions. The real question is, what will you do